Forex, or the foreign exchange market, is the largest financial market in the world, larger even than the stock market, with a daily volume of over $5 trillion. Imagine if you could get a tiny slice of that market. That would equal millions, if not billions of dollars. Forex market is as old as money itself. Maybe not in the form we know it today, but it did. Under almost every video we upload, there are at least few comments about people claiming that they have made a fortune trading in the foreign exchange market. Usually they are directly recognized as spams, but sometimes they do get published. So here in this video, we will find out if you really can make money trading in the Forex market. But to figure that out, we have to understand a few key concepts. What is the Forex market and how exactly does it work? What are the three main ways traders use to make money? And finally, why most people end up getting scammed? Hey proactive thinkers, if you want to support this channel and help us make more videos and want your name at the end of the next video, make sure to check out our Patreon page. In fact, I will be posting weekly updates about the market, or sometimes I will pick up a company and analyze it to figure out if it's a good investment or not. So if you're interested in all of that, then make sure to check out our Patreon page. And now, let's get into it. When we talk about globalization, we mention things such as tourism, international flights, shipping, but we often ignore the role of financial institution in making that happen. In fact, without Forex, international trade is impossible. Since the existence of money, every country had its own currency. Even when gold was the currency of the world, not all gold coins were equal. Some were made out of good quality gold, others were mixed with other kind of metals. Hence, merchants always had the problem of measuring the value of different currencies. Fast forward to today, even when we created paper currencies and completely demolished the gold standard, that problem did not suddenly vanish. In fact, it became even more complicated, since each country created its own currency. Currently, there are around 180 currencies all around the globe. Let's say you live in the United States, and since it's summer, you decide to visit your northern neighbor, Canada. You can't simply use your US dollars there. You have to buy Canadian dollars. Only with them, you can pay for goods and services in Canada. If, let's say, hypothetically, $1 US is equal to $1 Canadian, using $100, you will buy 100 Canadian dollars. But if you look at the real world, $1 US is equal to 1.36 Canadian dollars, which means using $100, you can buy 136 Canadian dollars. Apple can't simply hire Chinese workers and pay them in dollars to manufacture your iPhone. They only can pay them in Chinese yuan. That's why they have to buy yuans first. And if they need to buy LCD screens for their latest flagship from Samsung, they have to purchase South Korean won to pay for these screens. And guess where all of these currency transactions take place? Exactly, the foreign exchange market, or Forex in short. The year 1996 saw the first generation of Forex online trading platforms. The internet made Forex trading so accessible that it became mainstream. Exactly like the internet made it so easy to invest in the stock market. There are essentially three ways to profit in the Forex market. The most popular is probably the spot market. It's just a fancier word for transactions with immediate delivery, such as when you buy gold, for example, you don't wait to receive it sometime in the future, like future contracts, but rather own it immediately. But in this case, we are talking about currencies. Currencies fluctuate all the time, and if you end up guessing right when a certain currency rises in value, as you do with stocks, you make a profit. At the end of the day, the currency is like any other commodity that's driven by demand and supply. Let's say, for the sake of example, $1 US equals to 2 Chinese yuan. If demand for Chinese yuan rises, or in other words, if more people decide to buy the Chinese yuan because, I don't know, they have set up factories in China and now they have to pay their employees, the value of the Chinese yuan will increase. So $1 will no longer be equal to 2 Chinese yuan, but rather to 1.5. Of course, it's an extreme oversimplification, but that's how it works in short. The number of factors that can influence the demand for a certain currency are so many that we can't cover all, even if this video is going to be an hour long. So let's take a look at a few important ones. The economic performance or the political situation can influence the demand for a certain currency, or the perception about the future of the economy. In June 2014, a single British pound equaled to $1.7. But then rumors spread that the UK might leave the EU. That scared off a lot of investors, so they pulled out their investments, and the demand for British pound slowly began to fall. Today, with 1 British pound, you can buy only $1.25. Or take an example of China. For the last 20 years, the Chinese economy was growing at an unbelievable rate. More and more businesses shifted their manufacturing to China. As a result of that, the Chinese yuan kept rising in value against other currencies such as the US dollar. Traders in the forex analyze the market and speculate about the future of a particular currency. If they expect it to rise, they buy a lot of it, hold it till the price rises, and then sell it, exactly as you do with stocks. But what makes this market much more lucrative is that brokers often provide to their clients unbelievable leverage. Leverage ratios 1 to 100 are very common in the forex market. That means if you trade using your $1,000, you can hold a position that's worth $100,000. If you end up making a small percentage in profit, it will be huge. On the other side, there are futures and forward contracts. They aren't really common among the traders. They're more often used by multinational corporations. Let's say company A that's based in the United States wants to sell t-shirts in the United States. Say the t-shirt costs 10 Mexican pesos to produce in Mexico, and company A wants to sell it for $15. And let's say hypothetically $1 equals to 1 Mexican peso. In this case, company A should make $5 in profit for each t-shirt sold. But what if by the time the Mexican firm manufactures all the t-shirts and delivers them to company A, the Mexican peso rises in value, or let's say 1 peso equals to $2. So a single t-shirt would cost now $20, and company A will make a loss if it sells them at $15 each. To prevent such things from happening or any other risk of price fluctuations, companies often buy future contracts to fix the rate at which the transaction will be completed. And if you want to buy cool t-shirts where you don't have to deal with any kind of price fluctuations, you can visit our store. Finally, we have launched our merch. T-shirts, hoodies, phone cases with beautiful designs that you will definitely love. So make sure to check out our store. And did I tell you that you will be supporting our channel to make more videos? The link will be in the description. Unlike the stock market, where you can analyze a certain company, figure out if it's undervalued or overvalued and make a rational decision that at least in the long run will pay back, Forex is different. It's more like speculations. There are simply too many factors that influence a certain currency, from tourism to geopolitical risks, which makes the market even more volatile. In fact, the major players are the banks that trade among each other in huge volumes that could easily crush you no matter how big is your capital. So it's common for amateurs to easily lose their position when they aren't well educated about the market. They can get emotional and make a wrong move. In some countries, the forex market is entirely unregulated, which makes it even riskier. A lot of brokers aren't trustworthy and can mislead their customers by betting against them, for example. Remember the unbelievable leverage you can get in the forex market we talked about earlier? Well, there is a downside to it. Many brokerage firms went bankrupt due to lousy leverage decisions. So if your position loses value to a point where you no longer meet minimum margin requirements, your broker will liquidate your assets to help assure that you don't lose more money than you put into the account. Beginner traders who are new to the game often make this mistake and quickly lose their capital. It's not to say that anyone who trades in the forex market loses, but risks are quite high. This video was made possible by these beautiful people who support us on Patreon, and if you want to support us as well for additional perks such as be the first to know where am I investing and why, then make sure to check out our Patreon page. Other than that, thanks for watching and until next time.